People often ask me, hey, you're pretty knowledgeable about cryptocurrencies, right? Could you tell me which cryptocurrency I should invest in? Well, I see this as a red flag because you're willing to follow someone else's opinion without developing a clear investment hypothesis for yourself. However, I also understand it because cryptocurrency is a relatively new asset class that's pretty volatile, and there are like 1,000 cryptocurrencies to invest in, and more than 90% of it is crap. Yep, the Sturgeon law is also applicable here. The biggest issue that I observe is that a lot of people don't have a structured approach when it comes to crypto investing, taking on too much risk or missing out on investment opportunities. The key here is to find a sweet spot between minimizing risk and minimizing the opportunity costs, and align these with your investment goals and risk tolerance. And actually, good long-term investment performance comes down to two key elements. One, having a rational investing framework, and two, preventing your emotions and other people's emotions overriding that framework. With these two elements, you can outperform the more financially educated people with just patience, discipline, and emotional control. In this video, I will not provide financial advice whatsoever, but I will provide you some general guidelines on investing and also a framework that you can use to construct your own cryptocurrency portfolio. And additionally, I will present some example portfolio allocations with different types of cryptocurrencies. It's important to note that the risk-return ratio has become less favorable over time as the prices of Bitcoin, Ethereum, and other altcoins have risen significantly over the past year. However, my hypothesis is that we will reach at least $4 trillion market cap in this cycle. Hence, there's a lot of room to grow. The question is, however, where the money will flow to within the cryptocurrency market, but more on that later. Let's discuss the importance of having clear guidelines when constructing a cryptocurrency portfolio. Before investing, it's crucial to think about your investment goals, and this depends actually on your current financial situation and your future capital needs. Start by asking yourself some key questions. Are you investing for wealth creation, so focusing more on long-term growth and maximizing the upside potential? Or are you more focused on wealth preservation, which focuses on limiting the downside risk and capital protection? Once you have determined your overall investment approach, it's a good idea to write this down and be very specific here. So this could be achieving a specific net worth target, or things like, okay, I want to rely less on my job as my main source of income. The act of writing down your investment goal is a very powerful exercise. It helps you clarify your intentions and also serves as a reminder why you invest in the first place. Next, you need to know how much volatility you can handle. And this is pretty obvious, but the golden rule of investing is never invest more than you can afford to lose. And this principle applies for both crypto and the stock market. If your investments is keeping you up at night, your portfolio might not be properly balanced. And your position should never put you at risk for serious financial consequences when something goes wrong. And it's important to note that cryptocurrency are obviously more volatile than the traditional stock market. The crypto market can experience significant price swings, which may not be suited for everyone's risk appetite. Then you need to consider your investment horizon, and this refers to the period of time when you're planning to hold your investments before you need to access your funds. Your investment horizon plays a significant role in your asset allocation. Generally speaking, younger investors can be more aggressive. They have more time to ride the fluctuations and recover from potential losses. On the other hand, those nearing a retirement need to be more conservative in their approach so that they can ensure that they have a stable income stream. When it comes to investing, it's oftentimes better to have a long-term horizon mindset. Trying to predict short-term market fluctuations is oftentimes difficult, if not impossible. By focusing on the long game, you can take advantage of the market's natural growth and avoid impulsive decisions based on market volatility. Personally, I tend to be more aggressive in my investments. I'm willing to take on more risk in pursuit of higher returns. My thinking is that worst case scenario, if my investments don't pan out as expected, I can always work until my retirement age. Great. Now that we have covered your investment goals, your risk tolerance, and your investment horizon, we can now develop your investment thesis. This is where you dive deep in the specific assets that you want to invest in. To create a solid investment thesis, it's good to break this down into three parts. 1, the asset class, then the sector or narrative, and 3, the asset itself. Start by considering the broader asset class that you're interested in. This could be bonds, equity, or cryptocurrencies. If you're leaning towards the cryptocurrency asset class, ask yourself why you believe that this asset class will grow in the future. For example, do you believe that investor portfolios will shift more towards cryptocurrency in the future? Look, I already know the answer to this question, but it's good to ask yourself these types of questions and seek the answers and also the underlying drivers behind them. So next, within the asset class, look at the specific sectors or narratives that you're interested in. This could be areas like AI, DeFi, or gaming. And also here, ask yourself why you believe in this sector or narrative. And finally, zoom in on the specific asset within the sector or narrative and ask yourself why this asset stands out in comparison with the rest in the sector or narrative. Taking the time to think through and write down your investment thesis is really crucial because it helps you create conviction in your chosen assets, which is really valuable when the market experiences a downturn. By having a clear thesis, you're less likely to panic sell when there's a lot of volatility in the market or negative news. And of course, it is still important to keep an eye out on any material changes in your specific asset class, sectors, and the specific assets that you have chosen to invest in. Your investment thesis is actually a living document that evolves when more information comes in. Once you have these 4 components in place, your investment goals, your risk tolerance, your investment horizon, and your investment thesis, you're well equipped to build your own cryptocurrency portfolio. Now, let's shift gears a bit and discuss the investment tactics. And these tactics are closely related to each other as they guide your decision-making process. So when to invest actually? Well, dollar cost averaging, or DCA, is the best investment tactic that you can use to navigate the ups and downs in the market, especially when it comes to volatile assets like cryptocurrencies. Instead of trying to time the market and guessing the best time to invest, DCA actually involves investing a fixed amount of money over regular intervals. For example, you might choose to invest 100 euros per week or 400 euros per month, regardless whether the prices are up or down. And the beauty of dollar cost averaging is that it takes the emotion out of the equation. When prices are soaring, it can be tempting to throw all your money in it, hoping that you can ride the wave. On the flip side, when prices are plummeting, fear might kicks in and you want to sell everything and run for the hills. But with DCA, you stick to your plan and keep investing that fixed amount, regardless what the market is doing. And over time, this approach will actually smooth out the short-term price impact. Some people argue that buying the dip is a better strategy than DCA. And indeed, there are moments when it's better to accumulate more assets. It's important to remember that you never know when the dip will keep dipping. And furthermore, the buying the dip mindset often leads waiting for the perfect moment to invest and forgoing to invest altogether, missing out on opportunities and gains. Next, you need to implement cyclicality into your portfolio. And here you need to understand the difference between risk on and risk off environments. Within a risk on environment, investors are more bold and optimistic, favoring more risky assets like tech stocks and cryptocurrencies. While risk off environments prefer stable investments like bonds or stacking up cash when investors are more cautious. And here is where it gets interesting, because you want to adjust your portfolio based on the market cycles. But, and this is really crucial, you want to avoid falling into the trap to time the market again. It's about riding the waves and not predicting every ripple. So during risk-on environments, you want to allocate more of your portfolio towards tech stocks or cryptocurrencies. And in risk-off environments, you want to stack more cash or make safer investments like bonds or ETFs. So here you see an example of an investment fund allocating their assets more towards stocks or bonds, depending on the macroeconomic conditions, where expansion can be seen as risk on and recession as risk off. Remember, it's not about drastic all or nothing moves. It's about fine-tuning your portfolio's dial, not flipping the switch. So before investing in any assets, it's crucial to set targets for profit taking. And these targets should be aligned with your investment goals and your time horizon. Look, it's always a good idea to take some profits along the way, but you also need to think about when you want to completely exit the asset, the sector, and the asset class. As we've seen with market cycles, assets will not go up only. Every bull market will be followed by a bear market and vice versa. When setting profit targets, you can consider the following factors: asset asset price, explosive growth, and market capitalization. So regarding the asset price, you can set partial take profit targets based on the asset price. For example, you might sell 50% of your holdings at target 1, 20% at target 2, and 30% at target 3. If an asset experiences explosive growth in a very short period, it might be a good time to take some profits, as this growth is oftentimes unsustainable. You can also use the overall market capitalization of the cryptocurrency market as a guide when you want to start selling. For instance, if the cryptocurrency market reaches a $4 trillion market cap, you may consider phasing out of the market and reallocating those investments to safer assets. Then we have portfolio rebalancing, and this is closely related to market cycles and profit taking. It involves a quarterly or annual review of your asset allocation and check whether this is still aligned with your long-term investment goals. As time passes, the performance of various assets in your portfolio will fluctuate, causing your asset allocation to deviate from your initial target. For instance, if certain cryptocurrencies in your portfolio experience a significant growth, they become overweighted, potentially exposing you to higher risk than you originally intended. So to maintain your desired asset allocation and effectively manage your risk, it's important to rebalance your portfolio per quarter or per annum. When you realize profits from your investments, you face the following decision. Should you hold your funds in cash, invest in less volatile assets within the cryptocurrency market, such as Ethereum and Bitcoin, or reinvest them in more safer assets like an S&P 500 ETF? Also, this depends on your own risk tolerance, your investment goals, and the market outlook that you have. Reinvesting in less risky cryptocurrencies lets you maintain exposure to the market while reducing your overall volatility. However, allocating profits towards more traditional assets like the S&P 500 ETF can provide diversification benefits and also more stability into your overall portfolio. Let's talk about cutting losses. In my opinion, you only need to consider cutting losses if your investment thesis has changed significantly. What do I mean by that? Well, if the fundamental reasons why you have invested in the cryptocurrency project has changed, well, then it's really time to reevaluate your position and cut losses. Now, I know that some people use stop losses in the cryptocurrency market, but I personally won't recommend that for the long-term investor. Why? Because the cryptocurrency market is very volatile, and these stop losses are better suited for short-term trading strategies. And if you're in it for the long haul, setting stop losses can maybe lead to prematurely selling your positions when there are market fluctuations or potential downturns. And I will be honest with you, if you have a low risk tolerance or limited funds, I would recommend to avoid the crypto market altogether and just invest in ETFs. Finally, it is good to have structure and allocations for your investments in your portfolio. So ETFs, separate stocks, bonds, cash, and cryptocurrencies. In the remainder of this video, I'm going to focus how you can structure your cryptocurrency portfolio into your overall portfolio. Let's talk about the concept of the minimum viable crypto portfolio. Just as in product development, where the minimum viable product is the simplest version that already provides value to users, a minimum viable portfolio is the basic allocation that aligns with your investment goals and risk tolerance. Think of this MVP portfolio as your starting point. As you gain more knowledge and experience in the crypto space over time, you can refine these allocations. And here's the key point. Performance tracking is essential. Your altcoins in your portfolio should at least outperform Bitcoin or Ethereum in the long term. If they're not, you might be better holding these relatively less risky assets. So lastly, let me emphasize two don'ts in your cryptocurrency portfolio. So avoid leverage and steer clear from meme coins. Yes, you might miss out on some quick gains, but you will also protect your capital from potentially devastating losses. Let's move on to the different cryptocurrency portfolio types. The examples that I will share illustrate the different ways how you can structure your cryptocurrency portfolio. It's important to remember that there is no one-size-fits-all approach here. Instead, your portfolio needs to be aligned with your investment goals, risk tolerance, and your investment horizon, as mentioned earlier. Let's take a closer look at the defensive portfolio. This portfolio prioritizes wealth preservation above aggressive wealth creation. In a defensive portfolio, you maintain some allocation towards the two largest cryptocurrencies, Bitcoin and Ethereum. These established assets assets provide a foundation of stability compared to the other cryptocurrencies. However, a key characteristic of this portfolio is that you have a significant allocation towards cash or stablecoins, which can exceed 50%. The exact percentage depends on your profit-taking strategy. It's also an ideal portfolio during the peak of the bull market when the euphoria is high and it's time to take profits, cashing out all the cryptocurrencies other than Bitcoin and Ethereum. Let's move on to the next portfolio, which I like to call the BTC portfolio. And as you might have guessed, this portfolio only consists of the two largest cryptocurrencies based on market capitalization, Bitcoin and Ethereum. Both Bitcoin and Ethereum have been around for several years now and have shown resilience throughout several market cycles, contributing to their perceived stability and credibility. If you're a new investor just getting started with cryptocurrencies, I would recommend this portfolio. So the initial allocation towards Bitcoin and Ethereum is 50-50, but you can always allocate more towards Bitcoin and Ethereum based on your personal preferences. If you have a strong conviction in one of the two assets, you can tilt your portfolio accordingly. The BTC ETH portfolio is well suited for long-term cryptocurrency accumulation via dollar cost averaging, as mentioned earlier. Focusing on just two well-known cryptocurrencies can make your portfolio easier to understand and to manage, which is recommended for newer investors. However, by focusing solely on Bitcoin and Ethereum, you can miss out potential benefits from other altcoins or sectors. The third portfolio expands beyond Bitcoin and Ethereum, including larger, well-established altcoins or blue chips. These blue chip altcoins such as Solana and Avalanche have demonstrated strong fundamentals, widespread adoption and a strong track record, which sets them apart from other altcoins in the cryptocurrency market. However, it's essential to note that the term blue chip is still subjective and relative, and even these altcoins carry inherent risks associated with the cryptocurrency market. So really take the time to understand these projects, assessing factors such as the use case, tokenomics, feasibility of the technology and its metrics compared to competitors. This moderate portfolio allocation consists of 40% Bitcoin, 30% Ethereum and 30% allocated to a selection of blue chip altcoins. This diversification strategy aims to balance the relative stability of Bitcoin and Ethereum with the growth potential of the carefully chosen altcoins. The fourth portfolio incorporates higher risk altcoins with the goal of potentially maximize upside potential. And these higher risk altcoins have smaller market caps but have the potential to have larger multipliers. And when we are venturing towards more higher risk altcoins, it's really essential to perform a due diligence on these protocols. This offensive portfolio strategy allocates equal portions of 25% each to Bitcoin, Ethereum, blue chip altcoins and high-risk altcoins. By spreading your investments across different risk levels and market caps, you aim to capture a wide range of potential returns while managing your overall portfolio risk. Now let's explore the very offensive portfolio strategy. And this approach really cranks up the risk to reward ratio compared to the portfolios that we have discussed earlier. This portfolio is designed for investors who have a very high risk tolerance and is focused on wealth creation instead of wealth preservation. This portfolio consists of 10% Bitcoin, 20% Ethereum, 40% blue chip altcoins and 30% high risk altcoins. The timing of this portfolio is crucial. It's particularly well suited just before or at the very beginning of the bull market. This positioning allows you to potentially capitalize on the explosive growth that often characterizes the early stages of the crypto bull run or another leg up. But I cannot stress enough how important due diligence becomes for this portfolio. When you're dealing with higher risk cryptocurrencies, thorough research is absolutely essential. As we wrap up, I hope this framework for portfolio creation has been helpful for you. Remember, there is no one-size-fits-all approach when it comes to investing. The key here is to find a strategy that is aligned with your investment goals and your risk tolerance. It is crucial to avoid blindly following other influencers when making investment decisions. And the most important part here is that what works for someone else may not work for you, and just blindly following them can maybe lead to financial ruin. Let me know in the comments how you create your own portfolio. As always, see you in the next video. Cheers!